What if the story you were told about what just happened is not wrong, but incomplete in a way that matters far more than people realize? What if the explanation that fits neatly into a headline hides mechanisms that most participants never see, yet live with the consequences of every time they fail? Because when markets move violently, especially in ways that feel sudden and disproportionate, the real danger is not the move itself, but the comfort people find in simple explanations. It's easy to accept a narrative when it sounds plausible, when it names a single cause, a single trigger, a single villain or event that allows the mind to relax and move on. But markets, like all complex systems, rarely behave that way. They don't collapse because of one headline, one person, or one decision. They collapse when pressure that has been building quietly is suddenly released through a narrow channel. And when that happens, the surface story almost never tells you where the pressure actually came from. This is why experienced observers grow skeptical, not when an explanation is dramatic, but when it is too clean, too convenient, too easy to digest. Because if something can erase tens of % of value across interconnected markets in a matter of hours, shouldn't the cause be equally substantial? Shouldn't it reflect deeper forces rather than a single announcement? And if it doesn't, what does that say about the system you're participating in? These are not conspiracy questions, they are structural ones. They arise naturally when scale, speed, and impact are wildly out of proportion to the official explanation. When a market that has traded for centuries experiences its most violent day in decades, it is reasonable to pause and ask, what conditions made this possible? Not who to blame, not who to accuse, but what configuration of incentives, rules, and behavior allowed such an outcome to occur so quickly? Because the truth is, markets do not break suddenly. They become fragile first, and fragility is rarely visible until stress reveals it. For long stretches of time, everything appears stable. Prices rise, liquidity feels abundant, leverage hides behind optimism, and risk is mistaken for opportunity. Then, one day, something relatively minor happens, and the system reacts as if it were struck at its core. This is the moment most people misunderstand. They assume the trigger caused the collapse, when in reality, the trigger merely exposed what was already there. Think about how often this pattern repeats across history, not just in finance, but in engineering, biology, and even personal lives. A bridge doesn't collapse because one car drives across it. It collapses because unseen stress accumulated until one more car was enough. A relationship doesn't end because of one argument. It ends because tension went unresolved until one moment made it undeniable. Markets are no different. They carry stress silently, invisibly, often disguised as confidence. So when you hear a clean story offered immediately after a violent move, it's worth asking, is this an explanation or a narrative designed to restore calm? Does it describe a cause, or does it simply assign a reason people can repeat without discomfort? And most importantly, does it help you understand what could happen next, or does it encourage you to stop thinking altogether? Because stopping thought is the most dangerous response to volatility. It creates the illusion that the event was isolated, unlikely to repeat, safely contained within a single moment. But if the true cause lies deeper, in structure rather than news, then repetition is not only possible, it is likely. This is where curiosity becomes a form of self-defense. Curiosity asks different questions. It asks why leverage was so widespread, why liquidity disappeared so quickly, why selling accelerated instead of stabilizing, why prices overshot in both directions, why certain participants seemed able to act calmly while others were forced into action. These questions do not require suspicion, they require attention. They shift focus away from personalities and toward mechanisms. And mechanisms matter because they persist long after headlines fade. A chairman comes and goes. A press release is forgotten.
But the rules of the game, the margin structures, the feedback loops, the incentives remain in place, waiting for the next moment of stress. This is why the most consequential events in markets often feel confusing in real time. They don't look like crises at first. They look like overreactions, glitches, anomalies. People say things like, "This doesn't make sense," or "the market is being irrational," without realizing that what they are witnessing is not irrationality, but a rational system responding to internal constraints they never bothered to understand. And this misunderstanding is costly because it leads people to focus on the wrong lessons. Instead of asking how exposure was created, they ask who predicted the move. Instead of asking how fragility formed, they ask when prices will recover. Instead of asking whether the system behaved as designed, they assume it malfunctioned. But what if it didn't malfunction at all? What if it worked exactly as intended under stress, revealing priorities that are invisible during calm periods? That possibility is uncomfortable because it suggests that risk is not evenly distributed, that rules do not affect all participants equally, and that outcomes are shaped less by intelligence than by positioning. This is not a moral claim, it is an architectural one. Systems reward certain behaviors and punish others regardless of intent. If you understand which behaviors are rewarded under stress, you gain clarity. If you don't, you mistake luck for skill and stability for safety. This is why moments like this matter more than years of gradual movement. They are stress tests that expose the real structure of the system. They reveal who has flexibility and who has obligations, who can wait and who must act, who can absorb losses and who is forced to realize them. These differences are invisible when prices drift upward and liquidity feels infinite, but they become painfully obvious when conditions tighten. So when you hear that the market reacted to news, it's worth asking, reacted how exactly? Through which channels? With what amplifiers? And affecting whom? Because markets don't react as a single entity. They react through layers, derivatives, funds, margin accounts, algorithms, clearinghouses, each with its own rules and thresholds. When pressure enters one layer, it transmits to others in ways that can accelerate far beyond the original impulse. This is how small sparks ignite large fires, not because the spark was powerful, but because the environment was dry. Ignoring that dryness doesn't make the system safer, it makes the next fire more surprising. And surprise is what hurts people the most. Not volatility itself, but unanticipated volatility. Not loss, but loss that arrives faster than adaptation. This is why understanding structure is not an academic exercise, it is practical. It helps you calibrate expectations, assess vulnerability, and decide where simplicity ends and danger begins. It helps you distinguish between noise and signal, between explanation and excuse. It forces you to confront an uncomfortable truth, that many participants are not wrong about direction, but wrong about durability. They are right until they are forced out, right until the system demands collateral they don't have, right until rules change faster than they can respond. And when that happens, correctness becomes irrelevant. Only survivability matters. So before asking whether the move was justified, or whether prices will bounce, or whether someone manipulated the market, it's worth stepping back and asking a deeper question. What kind of system produces outcomes like this, and what does participation in that system actually require of you? Does it reward patience or speed, capital or conviction, flexibility or precision? And are you positioned for the system you think you're in, or the system that actually exists when stress arrives? These are not conspiracy questions, they are structural ones. They arise naturally when scale, speed, and impact are wildly out of proportion to the official explanation. And the moment you feel the story is too simple is often the moment when clarity is most urgently needed.
Before we try to interpret meaning, intention, or consequence, we have to slow down and do something that surprisingly few people do after a violent market move: establish what actually happened in concrete terms, stripped of emotion, commentary, and narrative shortcuts. Because confusion often begins when facts are rushed, selectively framed, or blended with opinion before they are fully understood. On the surface, the sequence of events appears simple enough. Prices surged, momentum built, optimism grew, and then, within an extraordinarily short window, prices collapsed with a speed and magnitude that shocked even seasoned participants. Headlines summarized it in a sentence, commentators debated it for a day or two, then attention moved on. But when you look closely at the numbers, the timing, and the breadth of the move, the simplicity begins to dissolve. This was not a single instrument reacting in isolation. It was a coordinated repricing across related assets, derivative products, and equity proxies, all occurring within overlapping timeframes. That alone should prompt curiosity, because when multiple markets respond simultaneously, the explanation is rarely local. So let's anchor ourselves in observable facts. Prices reached levels not seen in years, in some cases decades, driven by a combination of renewed interest, macro narratives, and positioning that had been building steadily rather than explosively. Volume increased, but not in a way that suggested panic, at least not initially. Participation appeared broad, liquidity seemed available, and volatility, while rising, remained within what many would still consider manageable bounds. Then, in a remarkably compressed period of time, prices reversed sharply. Not drifted downward, not corrected gradually. They fell hard. Double-digit percentage declines unfolded within hours, not weeks. In valuation terms, on paper, this translated into hundreds of billions and, in some estimates, trillions of dollars in market capitalization erased across interconnected instruments. It's important to be precise here. These were not cash losses in a single ledger entry. They were changes in market valuation, reflecting how quickly prices adjusted under stress. Still, the scale matters because valuation reflects collective agreement, and that agreement shifted violently. The speed of the move is what demands attention. Markets fall all the time. Corrections are normal, but velocity is information. When repricing accelerates beyond historical norms, it suggests that participants are not calmly reassessing fundamentals, but responding to constraints. And constraints don't care about opinions. They care about rules, margin requirements, liquidity thresholds, risk limits. When those constraints are breached, behavior changes instantly. So the first question worth asking is not why did people sell, but who was required to sell, because required selling behaves very differently from discretionary selling. It doesn't wait for confirmation. It doesn't seek optimal prices. It executes because it must. And when enough forced selling converges in a narrow window, prices don't reflect consensus, they reflect clearance. Now consider the timing. The most aggressive part of the decline occurred during periods of peak liquidity, when markets were fully open and interconnected. This matters because it means the move was not driven by thin trading or overnight gaps alone. It happened when the largest players were present, when price discovery was active, and when automated systems were fully engaged. That challenges the comforting idea that this was just retail panic. Retail does not move markets like this at speed. Retail reacts, it does not cascade. Cascades require leverage, size, and interdependence. And that leads to another uncomfortable observation. The assets that declined were not limited to the original focus of attention. Related equities, derivative-linked funds, and even assets with different fundamental drivers experienced synchronized pressure. That synchronization is a clue. It suggests shared plumbing, shared exposure, shared risk management frameworks responding to the same signals. When a move spreads horizontally across instruments rather than vertically within one, it points to systemic mechanics rather than isolated sentiment. At this point, many people reach for a familiar explanation: news, a statement, a policy signal, something concrete to pin the move on. And yes, there was news. There is always news. But the real question is proportionality.
Does the informational content of that news plausibly justify the magnitude and speed of the response? Did it materially alter supply and demand in a way that logically supports such a repricing? Or did it simply arrive at a moment when positioning was already stretched, leverage already elevated, and tolerance for risk already thin? Because those are very different interpretations. One implies a rational update of expectations, the other implies a structural release of pressure, and the numbers favor the latter. Look at how quickly volatility spiked. Look at how bid-ask spreads widened. Look at how correlated assets moved together rather than independently. These are not signatures of thoughtful reassessment, they are signatures of stress, and stress reveals architecture. Another fact often overlooked is how uneven the experience was across participants. Some exited early with manageable losses or even gains. Others were wiped out in hours. The distribution of outcomes was not random. It was determined by leverage, liquidity access, and flexibility. Those without margin obligations could wait. Those with rigid requirements could not. This asymmetry is crucial because it explains why two people can hold similar views and experience radically different results. Belief does not override structure. Exposure does not equal vulnerability until constraints are triggered, and when they are, beliefs become irrelevant. This brings us to another numerical detail that deserves attention: the acceleration points. The decline did not proceed at a constant rate, it accelerated at specific thresholds, suggesting mechanical triggers rather than organic selling. Prices fell, paused briefly, then fell faster. That pattern aligns with margin calls being issued, risk limits being breached, and algorithms shifting from passive to aggressive execution. These are not emotional decisions, they are programmed responses, and once activated, they amplify momentum regardless of narrative. This is why focusing solely on the initial catalyst misses the story. The catalyst may explain the first step, but it does not explain the avalanche. Avalanches require slope, snowpack, and structure. A single sound can trigger them, but the sound is not the cause, the conditions are. So when people ask, why did it fall so much, the more accurate answer is often because it was able to. Able meaning structurally primed, able meaning interconnected, able meaning constrained by rules that turn price movement into obligation. And this ability is measurable. It shows up in leverage ratios, open interest, concentration of positions, and reliance on short-term funding. These numbers are rarely discussed in headlines, but they determine how a market behaves under stress far more than sentiment ever could. Another observable fact is how quickly confidence narratives shifted after the move. Before the move, optimism was framed as rational positioning. After the move, the same positioning was reframed as excess. This retrospective clarity is comforting but misleading. It suggests that the outcome was obvious when in reality it was only obvious in hindsight. What was observable in real time was not inevitability, but fragility. And fragility is harder to see because it hides behind normalcy. It doesn't announce itself. It accumulates quietly, reinforced by periods of stability that are mistaken for resilience. This is why episodes like this feel shocking even to professionals, not because they don't understand markets, but because markets behave very differently at the edges than they do in the middle, and most experience is gained in the middle. So if we step back and summarize what we actually know, stripped of story, prices rose to historically significant levels, positioning grew, leverage was present, interconnected instruments shared exposure, a trigger occurred, selling accelerated beyond discretionary behavior, valuation shifted violently, outcomes diverged sharply across participants. None of these facts require speculation, they are observable. The questions that follow naturally are not accusatory but analytical. Why was leverage tolerated at those levels? Why were margin thresholds aligned in ways that amplified rather than absorbed volatility? Why did liquidity vanish so quickly in instruments assumed to be deep? Why did risk management frameworks respond in synchrony rather than diversification? And perhaps most importantly, why do these patterns repeat across cycles despite decades of experience? These are uncomfortable questions because they challenge the assumption that markets become safer simply by becoming larger or more sophisticated. Sometimes scale increases fragility rather than reducing it. Complexity can mask risk instead of dispersing it, and efficiency under normal conditions can transform into brittleness under stress. If that is true, then episodes like this are not anomalies to be dismissed, but signals to be studied, not because they predict the next move, but because they reveal how the system actually behaves when tested. And understanding that behavior is far more valuable than any post hoc explanation designed to make the past feel orderly.
What makes moments like this truly unsettling is not the loss itself, but the uncomfortable realization that we have seen this movie before, and yet almost no one recognizes it while it is happening. That is the paradox at the center of every major financial disruption. By the time it becomes obvious, it is already irreversible. History does not repeat itself in identical events, but it repeats itself in structures, incentives, and human reactions that are remarkably consistent across centuries. When people say, "this time is different," they are rarely lying. They are usually focusing on surface details, new technologies, new instruments, new regulations, while missing the deeper mechanics that remain unchanged. And those mechanics are precisely what make episodes like this feel both shocking and strangely familiar. If we zoom out beyond the last few years, beyond this specific market or asset class, and examine long-term patterns, a clearer picture begins to emerge. Periods of stability breed confidence. Confidence encourages leverage. Leverage increases returns during calm conditions, reinforcing the belief that risk is manageable, even tame. Over time, what begins as prudent optimization slowly transforms into systemic fragility, not because participants become reckless, but because the system rewards behavior that works until it doesn't. This is how every major cycle matures. It starts quietly, rationally, almost invisibly. And that invisibility is its greatest strength and its greatest danger. Consider the historical record. In the late 1920s, leverage was justified by innovation and productivity gains. In the 1960s, it was justified by corporate dominance and global expansion. In the late 1990s, by technology and network effects. In the mid-2000s, by financial engineering and housing stability. In each case, the narrative was different, but the structure was the same. Rising asset prices validated borrowing. Borrowing amplified gains, and amplified gains reinforced the belief that risk had been fundamentally reduced, not eliminated, just controlled, until suddenly it wasn't. What people often miss is that the breaking point rarely arrives because fundamentals collapse overnight. More often, it arrives because the system reaches a point where it can no longer absorb small shocks without nonlinear reactions. Think of it like a bridge engineered to handle increasing traffic. Each additional car adds weight, but the bridge holds until it doesn't. The collapse is not caused by the last car alone, but by the cumulative load that went unexamined because nothing had failed yet. Markets behave the same way. The absence of failure is mistaken for proof of strength, and strength is assumed to be permanent. This assumption is deeply human. We extrapolate recent experience forward, not because we are irrational, but because it usually works, until history intervenes. One of the most consistent patterns across financial history is the compression of perceived risk late in the cycle. Volatility declines, correlations appear manageable, models show stability, risk premiums shrink. All of this signals safety to participants whose incentives depend on staying invested. But what it actually signals is a system that has optimized itself for normal conditions at the expense of resilience. And resilience is only visible when conditions are abnormal. This is why crises feel sudden. They are not sudden in formation, only in expression. The pressure builds gradually, silently, beneath the surface, masked by routine. Then something small happens, a policy shift, a pricing anomaly,
a change in liquidity, and the accumulated pressure is released in a way that feels disproportionate to the trigger. Observers search desperately for a cause that matches the magnitude of the outcome, but such causes rarely exist. The true cause is structural, not event-driven. And this structural vulnerability is not confined to any one market or era. It appears wherever leverage, confidence, and interconnectedness converge. That convergence is not accidental. It is the natural result of systems designed to maximize efficiency and return on capital. Efficiency, however, comes with a trade-off. Systems optimized for efficiency have less slack, less redundancy, less margin for error. They perform beautifully under expected conditions and fail dramatically under unexpected ones. This is not a flaw of intelligence or intent, it is a property of complex systems. Financial markets are among the most complex systems humans have ever built. They integrate technology, psychology, regulation, and global capital flows into a single, continuously adapting organism. Expecting such a system to fail gently is unrealistic. It fails where it is weakest, and those weaknesses are often invisible during periods of calm. Another historical constant is the role of belief. Not belief in a religious sense, but belief in narratives that explain why current conditions are sustainable. These narratives are not imposed from above, they emerge organically from experience. When something works repeatedly, people stop questioning why it works and begin assuming it will continue. This is how narratives harden into doctrine. Markets always recover. Diversification protects you. Liquidity is abundant. Central banks will intervene. Each of these statements contains truth, but none of them is universally true. Their danger lies in being treated as absolutes rather than probabilities. History shows that every one of these beliefs fails under specific conditions, and those conditions tend to appear simultaneously late in cycles. Liquidity evaporates when it is most needed. Diversification fails when correlations converge. Recovery takes longer than expected when leverage is high. Intervention creates second-order effects that introduce new fragilities. None of this is new. What changes is the context, not the pattern. And this raises an uncomfortable question. If these patterns are so well documented, why do they continue to catch people off guard? The answer lies not in ignorance, but in incentives. Modern financial systems reward participation, not caution. They reward performance relative to peers, not absolute safety. They penalize underperformance more reliably than they penalize excessive risk until the risk materializes, at which point the consequences are often externalized. This creates a subtle but powerful pressure to remain exposed even when risks are rising. Stepping aside too early carries social and professional costs. Staying in carries latent systemic costs that are invisible until it is too late. History suggests that most participants choose the former risk because it is immediate and personal, while the latter is abstract and delayed. This is not a moral failure, it is a structural one, and it helps explain why cycles persist despite awareness. Awareness alone does not change behavior when incentives remain unchanged. Another recurring theme is the illusion of control created by complexity. As financial instruments become more sophisticated, participants feel better equipped to manage risk. Derivatives, hedging strategies, quantitative models, all of these tools provide a sense of precision, and under normal conditions, they often work remarkably well. But complexity can also create hidden dependencies. When many participants rely on similar models, similar assumptions, and similar risk thresholds, diversity of behavior declines. The system becomes synchronized, and synchronization, while efficient, is dangerous under stress. It means that many actors will respond to the same signal in the same way at the same time. This is how localized issues become systemic events. It is not that everyone makes the same mistake independently. It is that the system encourages the same response. History is filled with examples of this phenomenon, from portfolio insurance in 1987 to mortgage-backed securities in 2008. Each innovation was designed to reduce risk. Each succeeded for a time, and each contributed to systemic instability when conditions changed. This is not an argument against innovation, but a reminder that innovation does not eliminate cycles, it reshapes them. The form of the crisis changes, but the underlying dynamics persist. Which brings us to the present moment. The specifics may differ, the instruments may be new, the terminology may be updated, but the core elements, leverage, confidence, interconnectedness, and compressed risk perception are all present. And when those elements align, history suggests that outcomes become less a matter of if and more a matter of how. How fast will adjustment?
What if the most dangerous misconception in modern markets is not that prices can fall, but that everyone is playing the same game under the same rules? Because once you strip away the charts, the headlines, and the reassuring language of free markets, what remains is an uncomfortable truth. Financial markets are not neutral arenas where skill alone determines outcomes, but layered ecosystems where different players operate with radically different tools, constraints, and objectives. And understanding this difference is not optional. It is the dividing line between those who survive market stress and those who are sacrificed by it. When volatility erupts, the damage is never evenly distributed. Losses concentrate where flexibility is lowest, where information arrives last, where capital buffers are thinnest, and where decisions must be made under pressure rather than design. This is not an accident. It is the natural consequence of how the system is structured. Institutions and individuals do not merely differ in size. They differ in time horizons, incentives, access, and power. And those differences matter far more during crises than during calm periods. In stable markets, these asymmetries are invisible. Everyone appears to be winning. But when stress arrives, the hierarchy is revealed with brutal clarity. Consider the role of time. Large institutions operate on multiple time horizons simultaneously. They can hedge short-term exposure while positioning for long-term outcomes. They can absorb temporary losses without being forced to liquidate. They can wait. The average individual investor cannot. Time becomes a luxury commodity, one that is hoarded by those with capital and denied to those without it. Margin calls do not care about your long-term thesis. Algorithms do not care about your conviction. Bills do not care about historical context. When forced selling begins, it disproportionately affects those whose time horizon is shortest, not because they are wrong, but because they are constrained. And constraints, not intelligence, determine outcomes under stress. This is why so many people are right and still lose money. They identify trends correctly, understand fundamentals accurately, and yet exit at the worst possible moment, not because they lack insight, but because they lack flexibility. Flexibility is not evenly distributed. It is purchased with capital, credit, and access. Another critical asymmetry lies in information, not just what is known, but when it is known and how it is interpreted. Institutions do not necessarily possess secret information in the conspiratorial sense, but they do operate within informational ecosystems that differ fundamentally from those available to individuals. They see flows rather than headlines. They observe positioning rather than sentiment polls. They analyze balance sheets rather than narratives. Most importantly, they understand how others are positioned. Knowing where stress will appear is more valuable than knowing what should happen. When large numbers of participants are clustered around similar strategies, similar leverage levels, and similar exit points, the system becomes predictable, not in direction, but in fragility. And fragility is exploitable. Again, this does not require malicious intent. It emerges naturally from transparency asymmetry. When one group must disclose positions while another can infer them statistically, Power flows in one direction. The retail participant reacts to price. The institutional participant anticipates reaction. That difference alone is enough to explain why losses cascade downward rather than upward. Then there is the asymmetry of rules. Markets are often described as rule-based, but rules are not static, nor are they applied symmetrically in effect. Changes to margin requirements, liquidity provisions, trading halts, and collateral rules are framed as technical adjustments, neutral safeguards designed to maintain stability, but their impact is never neutral. Every rule change shifts pressure from one group to another. Raising margin requirements, for example, does not punish the largest players, it advantages them. Those with deep capital reserves welcome higher barriers because they reduce competition. The same rule that protects the system also clears the field. This dual function is rarely acknowledged openly, but it is consistently observed historically. Regulation does not simply restrain behavior, it reshapes participation, and participation determines who bears the cost of adjustment. Another overlooked asymmetry is psychological. Institutions are not immune to fear, but they experience it differently. Decision-making is distributed across committees, models, and mandates. Responsibility is diffused. Losses are contextualized as part of a portfolio. A 20% drawdown is not an abstract metric. It is a threat to security, identity, and future plans. This psychological load influences behavior far more than spreadsheets suggest. Fear accelerates decision-making, narrows attention, and increases the likelihood of capitulation at precisely the wrong moment. The system does not exploit fear intentionally, it simply responds to it mechanically. But mechanical responses to emotional inputs produce predictable outcomes, and those outcomes tend to favor participants who are insulated from emotional pressure. Which raises a disturbing question. If outcomes are so consistently skewed, why do individuals continue to participate under these conditions? The answer lies in optimism bias and narrative framing. Participation is sold as empowerment, access is framed as equality, technology creates the illusion that information parity has been achieved. Everyone has the same charts, the same news feeds, the same indicators. What is less visible is that interpretation, timing, and optionality matter far more than raw data. Seeing the same information does not mean acting on it under the same conditions. Equality of access does not produce equality of outcome when constraints differ, and narratives that emphasize democratization often obscure structural disadvantages rather than eliminate them. This is why market participation feels fair during rising periods and predatory during declines. The system reveals its true character only under stress. Historically, every major financial disruption has followed this pattern. In the build-up phase, participation expands. Risk is reframed as opportunity. New entrants are encouraged. Barriers appear low. During the resolution phase, participation contracts. Rules tighten. Liquidity dries up. Those who entered last exit first. Capital concentrates. The cycle is not accidental, it is functional. It reallocates risk upward and losses downward, and it does so while maintaining the appearance of legality and order. No single actor needs to orchestrate it. The structure itself performs the function. This structural reality challenges one of the most comforting myths in finance, that markets are efficient arbiters of value in all conditions. Markets are efficient at clearing prices, not at distributing pain fairly. They reflect power dynamics as much as fundamentals, and ignoring this does not make it disappear. It only ensures surprise when it asserts itself. Which leads to a deeper, more uncomfortable question. Can individuals realistically protect themselves within such a system, or is participation inherently asymmetric by design? The answer is not binary, but conditional. Protection is possible, but it requires abandoning certain assumptions. It requires recognizing that leverage is not a neutral tool, that liquidity is not guaranteed, that rules can change when stress rises, and that narratives often lag reality. It requires shifting focus from prediction to resilience, from maximizing returns to maximizing survivability, from timing markets to understanding exposure. This is not glamorous advice.
It does not promise quick gains, but history suggests it is the difference between temporary loss and permanent exit. The most successful participants over long periods are rarely those who predict crises accurately, but those who structure their participation so that crises cannot destroy them. They assume volatility rather than deny it. They plan for disorder rather than perfection. They recognize that markets are not moral systems, they are adaptive systems, and adaptive systems do not reward fairness, they reward fit. Fit to structure, fit to incentives, fit to stress. So perhaps the most important question a participant can ask is not what will happen next, but what happens to me if I am wrong. Because being wrong is inevitable. Markets punish certainty far more reliably than ignorance. The difference between ruin and recovery lies in exposure management, not foresight. And this is where the conversation often becomes uncomfortable because it challenges the idea that everyone can win simultaneously. They cannot. Gains and losses are two sides of the same transaction. Stability allows that reality to be ignored. Volatility enforces it. In moments of stress, the system reveals who is providing liquidity and who is consuming it, who is absorbing losses and who is transferring them. These roles are not assigned randomly. They are determined by structure, and structure favors those who design it, understand it, and can endure its extremes. Which brings us full circle to the original discomfort, the sense that something is fundamentally unbalanced even when nothing illegal has occurred. That intuition is not paranoia, it is pattern recognition. History teaches that fairness is not an emergent property of markets. Stability is, liquidity is, price discovery is, but fairness must be imposed deliberately, and even then imperfectly. Without that recognition, participants mistake participation for partnership, access for equality, and technology for safety. And when the cycle turns, those misunderstandings become expensive. So the real question is not whether markets.
What if the greatest risk in markets is not volatility, leverage, or even manipulation, but the stories we tell ourselves to feel safe inside an unsafe system? Because long before capital is destroyed, something else quietly collapses: perception. Markets do not move on facts alone, they move on narratives, and narratives are powerful precisely because they simplify complexity into something emotionally tolerable. When reality becomes too uncomfortable, too uncertain, or too threatening, the human mind instinctively reaches for explanation, not necessarily the correct one, but the one that preserves psychological stability. This is where the most dangerous phase of any cycle begins, not at the top, not at the crash, but in the widespread acceptance of explanations that feel reassuring while being fundamentally incomplete. History shows that every major financial disruption is accompanied by a dominant story that explains away structural risk. These stories are not fabricated out of thin air. They are built from fragments of truth, selectively emphasized and strategically framed. A policy announcement, a geopolitical event, a personality change, a headline-friendly trigger, these become the cause because they are easy to understand, easy to repeat, and easy to accept. They offer closure. They suggest that the problem is identifiable, temporary, and external. And most importantly, they imply that once this single factor is resolved, normality will return. But markets rarely unravel because of a single factor. They unravel because of accumulated fragility. The narrative, however, rarely admits that. Why? Because fragility implicates the system itself, and systems are far harder to question than events. When people are told that prices fell because of a specific announcement, a specific decision, or a specific individual, it allows them to believe that without that factor, everything would have been fine. This preserves faith in the structure. It reassures participants that the system is fundamentally sound, merely disturbed. But what if the disturbance is not the cause, but the excuse? What if the event is simply the spark that ignites pressure that has been building for years? That possibility is deeply unsettling because it suggests that risk is not episodic, but embedded. And embedded risk cannot be wished away with explanations.
One of the most consistent patterns in financial history is narrative substitution, replacing structural explanations with situational ones. In 1929, it was speculation. In 1973, it was oil. In 1987, it was computer trading. In 2000, it was irrational exuberance. In 2008, it was subprime mortgages. Each of these explanations contained truth, but none of them alone explained the magnitude of what followed. They were symptoms elevated to causes, and that elevation served a purpose. It prevented deeper questioning. Because if the true cause were systemic leverage, incentive misalignment, or structural opacity, then accountability would be diffuse and solutions would be uncomfortable. It is far easier to point to a villain than to examine architecture, far easier to blame behavior than design, far easier to accept a story than to confront uncertainty. This is why narratives tend to harden immediately after shocks. The faster an explanation spreads, the less time there is for reflection, and the more emotionally satisfying the explanation, the more likely it is to be repeated. Media plays a central role here, not necessarily out of malice, but out of necessity. Complex systems do not compress well into headlines. Structural risk does not fit into a tweet. Incentive analysis does not drive clicks, but personalities do, events do, simplicity does. So the story becomes about what happened rather than why it was possible, and once that story is accepted, it shapes behavior going forward. People adjust to the narrative, not the structure. They hedge against the wrong risk. They prepare for the wrong recurrence. They wait for the same trigger to appear again, not realizing that the next crisis will arrive under a different name. This is how learning fails, not because information is unavailable, but because it is miscategorized. Another dangerous aspect of narrative dominance is moral comfort. Stories often imply fairness. They suggest that losses are the result of bad decisions, poor timing, or individual mistakes. This creates a sense of justice. Those who lost must have done something wrong. Those who survived must have done something right. But history suggests that outcomes in complex systems are not purely meritocratic, especially under stress. They are path-dependent. They depend on timing, liquidity, access, and constraints. Narratives that frame outcomes as deserved obscure the role of structure, and obscuring structure protects it from scrutiny. This is not accidental. Systems that distribute losses unequally require narratives that justify that distribution, otherwise participation would decline, which raises a disturbing question. How many participants continue to engage not because the system is fair, but because the story says it is? Belief is not optional in markets, it is foundational. Capital allocation depends on confidence, but confidence based on incomplete understanding is fragile. When it breaks, it does so violently. This is why narrative collapse often coincides with market collapse. When prices fall sharply, the dominant story is stress-tested. If it fails to explain reality convincingly, trust erodes rapidly. Participants then scramble for new explanations, often swinging to extremes, conspiracy on one end, denial on the other. Both are forms of narrative defense. One externalizes blame completely, the other internalizes it selectively. Neither addresses structure, and without addressing structure, the cycle remains intact. Perhaps the most insidious narrative is the idea that markets are inherently self-correcting in a way that benefits all participants over time. This belief is partially true in aggregate, but dangerously misleading at the individual level. Markets may recover, but not everyone recovers with them. Time heals indices, not necessarily lives. This distinction is rarely emphasized. Instead, recovery is framed as vindication, proof that the system works. But for those who were forced out near the bottom, recovery is irrelevant. They are no longer participants. Their losses have been realized and redistributed. The system did not fail. It functioned. It transferred risk and concentrated capital. Narratives of recovery obscure this transfer by focusing on endpoints rather than pathways. They celebrate resilience without examining who paid for it. And because the story ends on an upward chart, the memory of pain fades quickly. New participants enter. Old warnings sound outdated. The cycle resets. Another layer of narrative distortion comes from the conflation of explanation with control. When people understand why something happened, they feel more prepared for the future, even if that understanding is superficial. This creates a false sense of security. Knowing the last trigger does not protect against the next one. In fact, it increases vulnerability by anchoring expectations to past patterns rather than underlying dynamics. The next crisis rarely arrives in the same form as the last. It exploits different weak points. Those who prepare for repetition are often blindsided by variation. This is why true risk awareness focuses on structure, not stories. Structure persists, stories change. Yet structure is harder to internalize because it offers no clear villain, no simple fix, no comforting resolution. It demands humility. It demands acceptance of uncertainty. It demands recognition that control is limited. These are psychologically expensive realizations. Most people prefer a story that preserves agency, even if it sacrifices accuracy. This preference is not stupidity, it is survival instinct. But in markets, survival instinct can be misdirected. What feels safe emotionally may be dangerous financially. What feels explanatory may be misleading. And what feels resolved may be merely postponed. This brings us to a critical realization. The most dangerous narratives are not the ones that are obviously false, but the ones that are mostly true. They are credible enough to be trusted and incomplete enough to be harmful. They lull participants into thinking they understand what happened, when in reality they have only identified a surface catalyst. This partial understanding is worse than ignorance because it discourages further inquiry. It closes the case prematurely, and once a case is closed, behavior resumes as if risk has been neutralized. History shows that this is often the calm before the next adjustment. So what should a participant do in a world where narratives are inevitable and structures slow to change? The answer is not to reject all stories, but to interrogate them, to ask uncomfortable questions, to separate trigger from structure, to ask not just what happened, but what conditions made this possible, to notice when explanations focus on personalities rather than incentives, events rather than exposure, emotion rather than mechanics, to notice when relief comes too quickly, when closure feels too satisfying, because in complex systems, true understanding rarely feels comforting. It feels destabilizing. It challenges assumptions. It introduces doubt. And doubt, paradoxically, is a form of protection. It slows reaction. It widens perspective. It reduces overcommitment. In markets, doubt is not weakness. It is ballast. Without it, participants are at the mercy of whatever story dominates the moment, and stories change faster than structures, which leads to the final unsettling question of this chapter. If narratives are inevitable and structure—
What if real progress in markets has nothing to do with predicting the future, beating the system, or finding the next winning asset, and everything to do with redefining what survival, success, and intelligence actually mean inside an environment that is structurally indifferent to individuals? Because after stripping away the narratives, the cycles, the asymmetries, and the illusions of fairness, we arrive at an uncomfortable crossroads. Either we continue playing the same game with better stories, or we fundamentally change how we engage with risk itself. For decades, progress has been framed as optimization, higher returns, faster execution, more leverage, more access. But what if that definition is incomplete? What if the relentless pursuit of efficiency has quietly eroded resilience, leaving participants more exposed, not less? History suggests that systems optimized for performance tend to fail catastrophically when conditions deviate from expectations. And yet, most market education still revolves around performance metrics rather than survival metrics. We are taught how to win, not how to endure. We are taught how to enter, not how to remain. This imbalance matters because endurance, not brilliance, is what compounds over time. The participants who remain active across decades are rarely the most aggressive or the most certain. They're the ones who adapt,
who accept limits, who design their involvement around uncertainty rather than against it. This is where the idea of progress must be re-examined, not as domination of markets, but as coexistence with them. Coexistence means acknowledging that volatility is not a malfunction, but a feature. It means accepting that drawdowns are not personal failures, but structural events. It means building strategies that assume disorder rather than deny it. This is a profound shift because it moves the goal from maximizing upside to minimizing existential risk. And existential risk is the only risk that truly matters. You can recover from being wrong. You cannot recover from being eliminated. Real progress begins with recognizing that the most dangerous outcome is not losing money, it is losing optionality. Optionality is the ability to act in the future. It is the freedom to wait, to adjust, to respond. Leverage, concentration, and narrative-driven conviction all reduce optionality, even when they increase short-term gains. They narrow the range of possible futures. Resilient participation, by contrast, preserves optionality. It sacrifices speed for durability. It accepts slower compounding in exchange for longevity. This trade-off is rarely celebrated because it is invisible during bull markets, but over long horizons it is decisive. Another dimension of real progress lies in reframing intelligence. Market intelligence is often equated with information advantage or analytical sophistication. But in complex systems, intelligence is less about knowing more and more about less and less, and more about knowing what not to assume. It is about recognizing the limits of models, the fragility of correlations, the conditional nature of historical patterns. It is about understanding that uncertainty cannot be eliminated, only managed. This kind of intelligence is humble. It resists overconfidence. It values margin of safety over precision, and it treats surprise as inevitable rather than exceptional. Progress, then, is not becoming smarter than the market, but becoming less vulnerable to being wrong about it. This perspective also reframes success. Success is not defined by peak returns or perfect timing, but by continuity of participation, by the ability to stay engaged without being forced into decisions by stress, by the capacity to endure boredom, underperformance, and doubt without abandoning discipline. These qualities are not glamorous. They do not produce viral stories, but they are the common thread among those who navigate multiple cycles intact. The irony is that the behaviors most rewarded in the short term, confidence, decisiveness, conviction, are often the ones that create fragility over the long term. Meanwhile, behaviors that feel unproductive, caution, patience, restraint, quietly build robustness. This inversion is one of the hardest lessons to internalize because it contradicts cultural narratives about progress and mastery. We prefer heroes who conquer systems, not participants who respect their limits. Yet markets consistently punish hubris and reward humility over time. Another critical aspect of real progress is recognizing that not all participation is equal. Engagement should be proportional to understanding, resources, and tolerance for uncertainty. The idea that everyone should be fully invested at all times is a narrative convenience, not a structural necessity. There is nothing inherently virtuous about maximum exposure. Sometimes progress looks like stepping back, like holding liquidity, like choosing not to act when action is optional. In a world obsessed with activity, restraint becomes a competitive advantage. And restraint is only possible when success is defined internally rather than socially. Many destructive decisions are driven not by analysis, but by comparison, by fear of missing out, by pressure to conform, by narratives of inevitability. Progress requires disentangling personal strategy from collective emotion. It requires asking not what is everyone else doing, but what conditions must exist for my strategy to survive. This question shifts focus from outcomes to processes, from excitement to durability, from stories to structure. Real progress also demands a more honest relationship with risk. Risk is often framed as something to be taken or avoided. In reality, risk is something to be shaped. It can be distributed, buffered, delayed, or transformed, but it cannot be erased. Attempts to erase risk usually result in its concentration elsewhere. This is why systems that promise safety through complexity end up amplifying danger. Progress lies in simplicity, not simplistic thinking, but simple exposure. Clear understanding of what can go wrong, how it would affect you, and whether you can survive it. If you cannot articulate the worst-case scenario of your participation without panic, you are not prepared, you are hoping, and hope is not a strategy. This brings us to a final, sobering realization. Real progress is deeply personal. There is no universal solution, no optimal allocation, no perfect hedge. What is resilient for one participant may be reckless for another. Time horizon, income stability, psychological tolerance, and life circumstances all shape what progress looks like. The mistake is outsourcing this definition to narratives, benchmarks, or external validation. When progress is defined externally, participation becomes reactive. When it is defined internally, participation becomes intentional. And intention is the foundation of resilience. So perhaps the most meaningful progress we can make is not technological or financial, but conceptual. To stop asking how to beat markets and start asking how to coexist with them. To stop seeking certainty and start building adaptability. To stop mistaking movement for progress and start valuing endurance. These shifts do not eliminate risk, but they align participation with reality rather than fantasy. And alignment in complex systems is the closest thing to stability that exists. The open question, the one that lingers beyond this chapter, is whether individuals and institutions are willing to redefine progress in these terms, because doing so requires relinquishing comforting illusions. It requires accepting that markets are not puzzles to be solved, but environments to be navigated. It requires maturity over excitement, resilience over brilliance, and humility over control. And while that may not make for dramatic headlines, it may be the only path that allows participation without destruction. So the real question is not whether markets will change, they always do, but whether our definition of progress will change with them, or whether we will continue measuring success by standards that history has repeatedly shown to be fragile.
What if the real danger ahead is not another crash, not another manipulation, not another cycle repeating itself, but our refusal to accept what the system has already shown us about itself? Because by the time patterns become obvious, they are usually no longer avoidable, only survivable. And the most consistent pattern across financial history is not boom and bust, not bubbles and collapses, but denial. Denial that the rules have changed, denial that incentives shape outcomes, denial that power concentrates, and denial that systems designed for efficiency inevitably sacrifice resilience. The uncomfortable truth is that markets do not collapse because of ignorance alone. They collapse because too many participants internalize narratives that protect the system rather than themselves. They trust abstractions over mechanisms, stories over structure, promises over probabilities. And when those abstractions fail, the damage is not merely financial, it is psychological. Confidence fractures, agency erodes. People stop acting not because they lack information, but because the mental models they relied on no longer explain reality. This is where the final lesson emerges, and it is not about silver or leverage or margin requirements. It is about preparedness at the level that actually matters, cognitive preparedness. Are you prepared to operate without certainty? Are you prepared to act without validation? Are you prepared to hold positions, financial or philosophical, that may look wrong for long periods of time?
because the future will not reward those who are most confident, it will reward those who are most adaptable. And adaptability begins with recognizing that the system is not broken, it is functioning exactly as designed. The asymmetries, the sudden rule changes, the advantage of scale, the information gaps, and the uneven distribution of risk, these are not anomalies, they are features. Once this is understood, the conversation shifts from outrage to strategy. Not why is this happening, but how do I exist within this reality without being consumed by it? This shift is rare because it requires abandoning the comforting idea that fairness will eventually assert itself. History offers no such guarantee. Markets reward preparation, not virtue. They reward positioning, not participation. And they punish fragility, regardless of intent. This is why the most dangerous position is not being wrong, it is being fragile. Fragility is the inability to absorb shocks without permanent damage. It is leverage without margin for error. It is dependence on liquidity that may vanish. It is faith in rules that can change overnight. And fragility is often invisible during periods of stability. It masquerades as confidence. It feels like progress, until it doesn't. Robustness, by contrast, looks unimpressive. It accepts volatility. It tolerates underperformance. It keeps buffers. It avoids narratives that require everything to go right. It is not optimized, but it survives. And survival is underrated because it lacks spectacle. Yet survival is what allows optionality. Optionality is the ability to wait, to pivot, to exploit future dislocations rather than be destroyed by them. Without optionality, all decisions become reactive. With it, uncertainty becomes navigable. This is the lens through which the final chapter must be viewed. The question is no longer what will happen next, but what kind of participant will I be, regardless of what happens next? Will you be someone who needs constant affirmation from markets to feel secure, or someone who defines security internally through structure rather than sentiment? Will you be someone whose strategy depends on continuous growth, or someone whose strategy remains viable even during stagnation or contraction? These are not abstract questions. They determine whether volatility is an inconvenience or an existential threat. Another layer of this reckoning involves time. Modern markets compress time. News cycles accelerate. Price movements intensify. Reactions become instantaneous. In such an environment, long-term thinking becomes countercultural. Yet time is the only true advantage available to individuals. Institutions compete on speed, scale, and access. Individuals compete on patience, selectivity, and endurance. Trying to outplay institutions on their strengths is a losing strategy. The only viable edge is asymmetry of behavior, doing what institutions cannot or will not do. Institutions cannot be patient in the same way individuals can. They cannot remain inactive without justification. They cannot tolerate long periods of unexplainable positioning. Individuals can, but only if they reject the pressure to constantly act. This is why the final evolution of progress is psychological independence, independence from narratives, independence from benchmarks, independence from the need to be right in public. The capacity to say, "I don't know, and that's acceptable," is not weakness, it is strategic humility. And humility is protective. It prevents overexposure. It invites contingency planning. It acknowledges that survival is probabilistic, not guaranteed. This mindset does not eliminate fear, but it reframes it. Fear becomes information rather than paralysis. It signals concentration, fragility, misalignment. The absence of fear, ironically, is often a warning sign. It suggests overconfidence, complacency, or narrative intoxication. Mature participation does not aim to feel fearless, it aims to feel prepared. Preparedness is boring, it doesn't trend, but it compounds. There is also a moral dimension to this discussion, though it is rarely acknowledged. Systems that repeatedly transfer losses downward while privatizing gains upward erode trust over time. That erosion does not immediately appear in price charts, but it appears in behavior. Participation narrows, cynicism spreads, short-termism intensifies. Eventually, the system consumes its own credibility. This is not a prediction, it is an observable pattern across empires, currencies, and markets. The question is not whether this dynamic exists, but whether individuals recognize it early enough to adapt their behavior accordingly. Waiting for reform, fairness, or accountability is not a strategy. Those forces may arrive or they may not. Personal resilience cannot depend on institutional benevolence. It must be built independently. This brings us to the final, perhaps most unsettling question. If the system rewards those who understand its mechanics rather than those who believe its stories, are you willing to let go of the stories? The story that long-term always wins, the story that markets self-correct in time for everyone, the story that participation alone is enough. Letting go of these narratives feels like loss, but it is also liberation. It allows clearer thinking. It opens space for strategies grounded in reality rather than in hope. And perhaps that is the ultimate takeaway. Progress is not louder predictions or sharper opinions. It is the gradual alignment of behavior with how the world actually works. It is the acceptance that uncertainty is permanent, that power is unevenly distributed, and that survival requires design, not belief. The future will not belong to those who saw it coming. It will belong to those who were built to endure whatever arrived. So the final question is not whether you agree with this analysis. Agreement is irrelevant. The question is whether your current structure, financial, psychological, strategic, can withstand being wrong longer than the system can remain irrational. Because history suggests the system can remain irrational far longer than most participants can remain solvent. And understanding that, truly understanding it, may be the most important form of progress left.
What if the greatest shift in financial history is not happening in markets, institutions, or technology, but inside the minds of those who are watching it unfold? Because every major transformation in history was preceded not by a crash, but by a silent psychological transition that most people failed to notice while it was happening. Empires did not fall when armies crossed borders. They fell when belief systems quietly fractured. Currencies did not die when printing presses accelerated. They died when trust silently evaporated. And markets will not fundamentally change because of regulation, innovation, or disruption, but because participants themselves are changing how they perceive risk, power, and reality. Ask yourself this: when did you last feel genuine confidence in the financial system? Not in your personal strategy, but in the system itself. And if that confidence is fading, what replaces it? Fear, indifference, or strategic detachment? This is the inflection point that rarely appears on charts, a moment where people stop believing the system is a path to stability and start treating it as a battlefield. This psychological shift transforms behavior. Long-term planning gives way to hedging. Loyalty to institutions turns into skepticism. Participation becomes conditional. And once that mental pivot occurs at scale, the system itself begins to behave differently. Liquidity becomes more fragile. Volatility becomes more persistent. Narratives lose their stabilizing power. The invisible glue that holds markets together, shared belief, weakens. And belief is the most undervalued asset in any system. Without it, every structure becomes brittle. But here is the paradox. As belief declines, awareness increases. People begin to ask questions they never asked before. Who benefits when markets rise? Who absorbs losses when they fall? Who writes the rules and who merely plays by them? Why do crises always seem to concentrate wealth rather than distribute it?
And if cycles are predictable, why are participants consistently surprised? These questions mark a cognitive awakening that cannot be reversed. Once seen, it cannot be unseen. And once enough participants see it, behavior changes irreversibly. The system adapts, but always with lag. This lag creates windows of opportunity and danger simultaneously. Those who recognize the shift early can restructure, hedge, and reposition. Those who cling to old mental models become vulnerable. History is ruthless in this regard. The printing press destabilized religious authority. The Industrial Revolution destabilized monarchies. The Internet destabilized media. And now financial transparency, however imperfect, is destabilizing centralized narratives of stability. People no longer accept "trust us" as sufficient. They demand mechanisms, incentives, and alignment. But demanding is not the same as controlling. Power still concentrates, complexity still obscures, scale still dominates. The difference is psychological. Participants are no longer naive, they are pragmatic, skeptical, and increasingly strategic. This creates a new environment where trust is replaced by verification, loyalty by optionality, and participation by conditional engagement. But this environment is mentally taxing. Constant skepticism is exhausting. Living in a world where every narrative must be interrogated is cognitively expensive. So many people choose a middle path, strategic disengagement. They stop caring about the system's fairness and focus solely on navigating it. This is neither cynical nor idealistic, it is adaptive. But what does this mean for the future of markets? It means markets become less ideological and more tactical, less driven by shared dreams, more driven by individualized survival strategies, less stable in the long term, more efficient in the short term, less forgiving of ignorance and more rewarding of structural awareness. This is not a dystopia or a utopia, it is an evolutionary stage, and evolution is indifferent to comfort. Another layer of this transformation is technological mediation. Algorithms now shape perception. Feeds curate reality. Price movements trigger automated responses. Human psychology is increasingly filtered through machine systems optimized for engagement and efficiency. This creates reflexive loops. People react to machines reacting to people. Sentiment amplifies. Volatility becomes self-reinforcing. Crises propagate faster than comprehension. In such an environment, slow thinking becomes rare, but more valuable than ever. The question becomes, can individuals maintain independent cognition in an ecosystem designed to accelerate emotional reactions? Can you slow down when every signal demands speed? Can you remain detached when every metric demands participation? These are not philosophical questions, they are survival questions. Because the future participant is not someone who predicts perfectly. It is someone who resists being emotionally synchronized with the system. Emotional synchronization is dangerous. It creates herd behavior, bubbles, panics, and crashes. Desynchronization, acting independently of crowd emotion, is the only durable edge left. But desynchronization is lonely. It feels wrong. It invites doubt. It requires a strong internal framework, and most people never build that framework. They outsource conviction to markets, influencers, analysts, or institutions. When those sources fail, their decision-making collapses. This is why the final frontier of financial progress is not technical, it is psychological sovereignty. The ability to think clearly in chaos, the ability to act rationally in euphoria, the ability to wait in boredom, the ability to detach from identity tied to market outcomes. Identity is the hidden variable. When people identify as investors, traders, or believers in a system, losses become personal, gains become ego, decisions become emotional. Psychological sovereignty dissolves that identity. It reframes participation as a tool, not a self-definition. This shift is subtle but transformative. It reduces fear, greed, and narrative attachment. It increases optionality.
It turns markets from areas of validation into environments of opportunity. But psychological sovereignty is rare because it conflicts with human nature. Humans seek belonging, validation, narrative coherence. Markets offer all three. Breaking that bond requires deliberate effort, yet those who succeed gain something invaluable: clarity. Clarity about incentives, clarity about risk, clarity about power structures, clarity about their own limits. And clarity is the foundation of strategy. Without clarity, strategy becomes storytelling. With clarity, storytelling becomes irrelevant. The final question, then, is not about silver, stocks, or cycles. It is about consciousness. Are markets evolving faster than human cognition can adapt? And if so, what happens when most participants operate with outdated mental models in a hyper-accelerated system? Does instability become the norm? Does complexity increase fragility? Or does adaptive behavior eventually create a new equilibrium? History suggests both. Periods of disruption lead to new forms of order, but only after massive dislocation. The challenge is surviving the dislocation with agency intact. This is why the most valuable asset in the future may not be capital, information, or technology, but composure. Composure in uncertainty, composure in volatility, composure in ambiguity. Because ambiguity is the defining feature of the future. Not chaos, not collapse, not prosperity, ambiguity. Multiple plausible outcomes, conflicting signals, competing narratives, and no definitive roadmap. Those who require certainty will suffer. Those who can operate probabilistically will thrive. This is the ultimate evolution of participation. Markets as probabilistic ecosystems rather than deterministic machines. Participants as adaptive agents rather than believers. Strategies as living frameworks rather than static plans. And perhaps the most unsettling realization is this: the system doesn't need to be fair to be functional. It only needs participants who believe they can navigate it. Once belief in navigability collapses, participation declines. But belief in navigability is not the same as belief in fairness. People will engage in unfair systems if they believe they can survive and succeed within them. The future may not be fairer, but it may be more transparent in its unfairness, and transparency changes behavior. So the final question that lingers is not whether the system will collapse or endure, it is whether you will evolve faster than the system itself. Because systems change slowly, minds can change instantly, and those who change first rewrite the rules for themselves. In a world where narratives dissolve and certainty disappears, the ultimate advantage is not prediction, wealth, or influence. It is the ability to remain conscious, adaptive, and strategically detached in a system designed to overwhelm cognition. And if history is any guide, the future will not be decided by those who saw it.
What if the final risk is not financial, not systemic, not even psychological, but existential in the sense that most people never realized they were never playing the same game to begin with? Because once all the layers are stripped away, cycles, leverage, narratives, institutions, technology, we are left with a stark realization. Markets are not arenas of equal opportunity, they are filters. And over time, they select not for intelligence, effort, or morality, but for structural alignment. This is the uncomfortable endpoint few are willing to reach, the idea that outcomes are less about what you know and more about how you are positioned relative to forces you cannot control. And this realization changes everything because it forces a final question that most people avoid for their entire lives. If the system does not reward virtue, effort, or even correctness in a consistent way, what exactly am I optimizing for? Is it wealth, stability, freedom, dignity, or simply the ability to make choices without coercion? These are not philosophical luxuries, they are practical necessities in an environment where participation itself carries risk. For decades, people were told that engagement was inherently positive, that investing, saving, and trusting institutions was a form of civic virtue.
But what happens when engagement becomes a liability? When exposure rather than ignorance is what creates vulnerability? When doing the right thing produces worse outcomes than doing nothing at all? This inversion is destabilizing because it breaks the moral contract people believe exists between effort and reward. And once that contract breaks, motivation changes. People stop optimizing for growth and start optimizing for survival. They stop asking, how do I get ahead, and start asking, how do I avoid falling behind? This subtle shift marks the end of innocence in any system, and systems without innocence behave differently. They become more transactional, more defensive, more fragmented. Trust declines, cooperation weakens, short-term thinking intensifies, and the burden of risk shifts downward. This is not theory, it is observable in every late-stage system throughout history. Rome, the British Empire, post-war Bretton Woods, each entered a phase where complexity increased, incentives misaligned, and individual actors were forced to prioritize self-preservation over collective ideals. The result was not immediate collapse, but prolonged instability punctuated by crises. And during those periods, the people who fared best were not those who predicted events correctly, but those who understood the structure early enough to disengage selectively. Selective disengagement is the most misunderstood concept in modern finance. It does not mean abandoning participation entirely. It means refusing to participate on terms that expose you to asymmetric downside without commensurate control. It means recognizing when a system requires belief to function and withdrawing belief while maintaining optionality. This is uncomfortable because belief is socially reinforced. Disbelief isolates, but isolation is often the price of autonomy. Ask yourself this: how many decisions in your financial life are driven by genuine conviction, and how many are driven by fear of being left behind? Fear of missing out is not greed, it is social pressure masquerading as opportunity. And social pressure is one of the most powerful forces in markets because it synchronizes behavior. Synchronization creates fragility. Everyone buys together, everyone sells together, everyone panics together. The system appears stable until it isn't. Those who desynchronize, who act independently of crowd emotion, appear wrong until they aren't. This dynamic never changes. What changes is the speed at which it unfolds. Technology compresses reaction time. Narratives propagate faster. Corrections become sharper. Recovery windows shorten. In such an environment, the margin for error shrinks. This makes structural positioning more important than ever. And structural positioning has little to do with forecasts. It has everything to do with exposure, leverage, liquidity, and time horizon. Time horizon is the most underestimated variable in financial survival. Those with long horizons and stable cash flows can absorb volatility. Those without are forced into decisions at the worst possible moments. This is why inequality compounds during crises, not because the wealthy are smarter, but because they are not forced to act. They can wait. Waiting is power. And power in markets is the ability to delay decisions until conditions are favorable. Most people do not have that power. Their exposure is fixed, their liquidity is limited, their obligations are immediate. This asymmetry defines outcomes more than intelligence ever could. And acknowledging this is painful because it undermines the meritocratic narrative that sustains participation. But denial does not change structure, it only delays adaptation. Another uncomfortable truth emerges here. Information is not the edge people think it is. Information is abundant. Everyone has access to charts, data, analysis, and opinions. What differentiates outcomes is not information, but interpretation under pressure. How do you behave when information conflicts, when experts disagree, when data changes faster than comprehension? Most people revert to emotion. Fear, hope, anger, and relief drive decisions. This is not a moral failing, it is human nature. But systems do not care about human nature, they exploit it. Algorithms are designed to front-run emotion. Institutions are structured to offload risk. Media amplifies urgency. Together, they create an environment where acting calmly becomes increasingly difficult. This is why the ultimate edge is not intelligence, but emotional insulation, the ability to experience volatility without internalizing it, to observe without reacting, to delay without freezing. This capacity is rare because it must be built intentionally. It does not emerge naturally, and it cannot be outsourced. Advisors, models, and strategies can fail. Psychological resilience cannot be delegated. It must be cultivated. This brings us to the final realization of the series. The system does not need to collapse for most participants to lose. It only needs to remain volatile, unequal, and psychologically exhausting. Attrition, not catastrophe, is how most people are eliminated. They leave quietly. They disengage after losses. They lose confidence. They stop participating. Meanwhile, the system continues, smaller, more concentrated, more dominated by those who can endure. This is how power consolidates without violence, through fatigue, through complexity, through asymmetry. And this is why the question, what happens next, is less important than who remains, because the future belongs not to those who are right, but to those who remain solvent, sane, and flexible long enough to benefit from eventual reordering. Reordering always happens, excesses correct, imbalances adjust, but the timeline is unknowable, and the cost of waiting unprepared can be permanent. So the final call to action is not urgency, it is clarity. Clarity about what you are exposed to, clarity about what you can withstand, clarity about what you truly want from participation, not the fantasy version sold in narratives, but the real version aligned with your life, obligations, and psychology. Because once clarity exists, strategy becomes simpler, not easier, but simpler. You stop chasing every opportunity. You stop reacting to every signal. You stop mistaking motion for progress, and you start designing participation around survivability. This is not pessimism, it is realism, and realism is empowering because it replaces hope with agency. Hope is passive, agency is active. Agency allows you to say no, to reduce exposure, to hold liquidity, to step aside when conditions are unfavorable, to re-enter when they improve. These options are invisible to those who are fully committed at all times. Commitment without flexibility is fragility. Flexibility without commitment is paralysis. The balance between the two is where resilience lives, and resilience is the true endgame. Not beating markets, not predicting cycles, not finding perfect assets, but remaining capable of choice in an environment designed to remove it. So as this series concludes, the final question is not what will markets do, or who is manipulating whom, or which asset will outperform. The final question is far more personal and far more difficult. If the system continues exactly as it is, volatile, unequal, narrative-driven, and indifferent, are you structurally positioned to endure it without losing yourself? Because systems do not care about fairness, they care about function, and the only leverage individuals ever truly have is understanding when to participate, when to withdraw, and when to wait. Everything else is noise.
What if the real ending is not collapse, recovery, or transformation, but normalization, where instability becomes so familiar that people stop recognizing it as instability at all? Because history rarely ends with dramatic finales. It ends with quiet adjustments that slowly redefine what people consider acceptable, livable, and normal. The most dangerous moment in any system is not when it is breaking, but when people adapt to the break and build their lives around dysfunction. Ask yourself this: how many things today would have been considered unacceptable, outrageous, or temporary just one generation ago, but are now treated as permanent features of reality? High volatility, permanent debt, constant uncertainty, delayed milestones, fragile institutions. None of these arrived overnight. They crept in gradually, each justified as an exception, a response to crisis, a short-term necessity. and now they form the baseline. This is how systems survive without resolving their contradictions. They externalize the cost onto individuals and wait for adaptation. And humans are remarkably adaptable, sometimes to their own detriment. Adaptation without agency is not resilience, it is normalization of loss. And once loss is normalized, resistance fades. People stop asking, "Should this be happening?" and start asking, "How do I live with this?" That shift marks the true end of any era, not when systems fail, but when people stop expecting them to work. This is the psychological settlement phase, the moment when hope is replaced not by despair, but by resignation masked as pragmatism. People still participate, they still invest, they still work, save, plan, but the underlying belief has changed. The belief is no longer that the system will reward them, but that disengagement is not an option. Participation becomes compulsory rather than aspirational, and compulsory participation creates a different kind of behavior, more cautious, more transactional, more defensive. Dreams shrink, time horizons shorten, risk tolerance collapses, not because people are irrational, but because they are tired. Fatigue is the most underestimated force in economics, not fear, not greed, fatigue. The exhaustion of constantly adapting to moving goalposts, the weariness of being told that stability is coming while reality delivers more volatility, the cognitive load of navigating complexity with limited margin for error. Over time, fatigue erodes ambition. People stop trying to optimize, they aim to endure. And endurance, while admirable, is not the same as progress. So what does progress mean in a world where systems no longer promise improvement, only continuity? Is progress higher income, greater efficiency, more optionality, or simply fewer negative surprises? These questions matter because they redefine what people are willing to accept and what they are willing to fight for, and systems respond to expectations. Lower expectations reduce pressure for reform. Higher tolerance for dysfunction extends the lifespan of flawed structures. This is not a conspiracy, it is a feedback loop. The more people adapt, the less incentive exists to change, and the less systems change, the more adaptation is required. This loop is stable, but it is not healthy. Another layer to this normalization is narrative management. Stories adjust alongside expectations. Risk becomes opportunity. Precarity becomes flexibility. Volatility becomes innovation. Language softens reality, and softened language dulls urgency. When instability is reframed as progress, resistance appears irrational. Those who question it are labeled pessimistic, outdated, or resistant to change. This social pressure reinforces compliance, not through force, but through framing. And framing is powerful because it shapes perception before analysis even begins. If you believe volatility is normal, you stop preparing for stability. If you believe uncertainty is inevitable, you stop demanding clarity. If you believe responsibility is individual, you stop questioning structure. These beliefs do not need to be imposed. They emerge organically through repetition. This is how normalization works, quietly, incrementally, until alternatives feel unrealistic. And yet, alternatives always exist. They just require imagination and courage, two things that fatigue erodes. So the final chapter is not about what will happen next. It is about awareness. Awareness of how normalization shapes behavior. Awareness of how expectations are engineered. Awareness of how survival strategies quietly replace aspirations. This awareness does not guarantee better outcomes, but without it, decline feels inevitable. With it, agency reappears. Agency does not mean control over systems, it means control over exposure, participation, and interpretation. It means deciding which risks are acceptable and which are not,
which narratives you internalize and which you reject, which timelines you commit to and which you leave open. Agency is subtle. It rarely looks heroic. Often it looks like restraint, like saying no when everyone else says yes, like waiting when everyone else is rushing, like choosing stability over excitement, clarity over noise. These choices are unglamorous. They do not trend, they do not go viral, but they compound quietly, and quiet compounding is the only kind that survives normalization. Another uncomfortable truth emerges here. Most people do not lose because they make catastrophic mistakes. They lose because they accept small compromises repeatedly. A little more leverage, a little less margin, a little more optimism, a little less skepticism. Each decision feels reasonable in isolation. Together, they create fragility. Normalization accelerates this process because it shifts baselines. What once felt risky now feels standard. What once felt unacceptable now feels unavoidable. This is how people drift into vulnerability without ever choosing it consciously. The antidote is not alarmism, it is recalibration. Periodic reassessment of assumptions, asking uncomfortable questions before conditions force them. Questions like, what am I assuming will continue that might not? What risks am I ignoring because they are inconvenient? What narratives am I relying on for comfort rather than accuracy? These questions are destabilizing, but they are protective. They interrupt normalization. They restore perspective. And perspective is the rarest resource in environments saturated with information. So as the series ends, the most important takeaway is not pessimism or optimism. It is vigilance. Vigilance against passive adaptation, vigilance against borrowed beliefs, vigilance against equating survival with success, because survival is only meaningful if it preserves the ability to choose differently when conditions change. Otherwise, it becomes slow erosion, and erosion is invisible until it's irreversible. The future will likely not announce itself with a single defining event. It will arrive as a continuation of trends already underway. More complexity, more mediation, more volatility, more individualized risk, and fewer guarantees. The question is not whether this future is good or bad. The question is whether you are consciously adapting or unconsciously normalizing. Because unconscious normalization is how systems extract value without resistance. Conscious adaptation is how individuals retain dignity within imperfect systems. And dignity, not wealth, not prediction, not dominance, may be the most underappreciated metric of success in the age ahead. Dignity means understanding the game without being consumed by it, participating without surrendering identity, accepting uncertainty without internal collapse. It is the ability to say, I see this clearly, and I choose how much of myself to offer. That choice is the final form of freedom available in any system, and systems cannot take it unless it is willingly surrendered. So the final question, the one that lingers after all charts fade and narratives dissolve, is simple but relentless. Are you adapting because you are aware, or because you feel you have no alternative? The answer to that question determines whether normalization becomes a trap or a platform for deliberate, conscious survival in a world that no longer promises more than continuity.